Good evening. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on Powering the Future, where renewables meet storage. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel of speakers. Mr. Karthikeya Sharma, co-founder and chief business officer at Sunshore Energy. Mr. Neeraj Gupta, CFO at Purva Green. Mr. Pavan Agarwal, MD and CEO at Vari Group's Renewable IPP Business. Mr. Mithil Modi, Business Head, Clean Tech and Infrastructure Finance at Tata Capital. This session will be moderated by Jatan Arya, Director at CareEdge Ratings. We will begin this webinar with a presentation by Soumya Ahuja, Associate Director at CareEdge Ratings. Following the presentation, we will move into a panel discussion followed by a Q&A session. For any questions, please key them into the chat panel. We will address them towards the end of the session. With that, may I invite Soumya Ahuja to take this session, please.
Good afternoon, everyone, and welcome. The topic for today's webinar is Powering the Future, where renewables meet storage. As India accelerates its clean energy transition, the conversation is no longer just about adding renewable capacity, but about ensuring reliability, flexibility, and round-the-clock power. Renewable energy and storage together form the backbone of this transformation, enabling grid stability, managing intermittency, and supporting growing demand in a sustainable manner. Today, we will explore how this integration is reshaping tariff discovery, project economics, and the broader power sector landscape. On agenda today, we will take a closer look at the progress made in the energy storage segment, along with key sector-specific trends, policies, and challenges. The session will cover the following: evolution of capacity additions and CareEdge Ratings view on future additions, RCO and ESO trajectory, policy initiatives for ESS, comparison between key technologies, that is PSP and BESS, tender activity reflecting storage becoming the front runner, sector headwinds and tailwinds, and lastly, we will speak about CareEdge Ratings outlook on the sector. As reflected in Exhibit 1, as of December 2025, India's total installed power capacity stands at around 510 gigawatt, with renewable energy emerging as the central pillar of the country's power mix. Renewable capacity has reached 207 gigawatt, accounting for 40% of total installed capacity, reflecting sustained growth and a clear structural shift toward cleaner energy sources. The solar power segment continues to dominate with an installed capacity of 136 gigawatt, accounting for 66% of the total renewable capacity, followed by wind power at 55 gigawatt, representing approximately 26% of the renewable mix. India's cumulative renewable capacity has demonstrated consistent expansion over recent years. As reflected in Exhibit 3, capacity increased from 94 gigawatt in financial year 21 to 207 gigawatt in 9 months financial year 26, and is projected to further scale up to around 260 gigawatt by financial year 27. Renewable energy installations are expected to accelerate significantly, with annual additions likely to reach a run rate of around 45 gigawatt by financial year 27. This growth trajectory is supported by strong policy initiatives, increasing investor interest, and a robust project pipeline exceeding 140 gigawatt. Despite the rising share in total installed capacity, renewable energy contributes only around 15% of actual energy generation, primarily due to lower plant load factors resulting from intermittency. However, with energy storage solutions gaining prominence, this share is expected to increase over time. As shown in Exhibit 5, India is on track to achieve 500 gigawatt renewable capacity target by 2030, as set by the CEA in December 2022. CareEdge Ratings has made an attempt to forecast the future capacity as well as generation mix, assuming non-fossil fuel capacity to increase in a phased manner and reach 460 gigawatt in Scenario 1 and 500 gigawatt in Scenario 2. The overall growth in energy demand has been assumed at a CAGR of around 6%. Further, the share of non-fossil fuel generation is expected to exceed 40% of the overall generation, even if we achieve an installed non-fossil fuel-based capacity of 460 gigawatt. India's power sector is projected to need approximately 42 lakh crore in cumulative capex by financial year 32 to achieve its capacity expansion and energy transition goals. Majority of this investment of around rupees 24 lakh crore will be allocated to renewables and hydro, along with an additional rupees 2.7 lakh crore for energy storage. This scale of investment will necessitate substantial debt financing, estimated at about rupees 20 lakh crore. Overall, this capex demand highlights a significant financing opportunity across generation, transmission, and storage sectors, with renewables and grid infrastructure representing the largest share of investment. To support the 500 gigawatt non-fossil fuel target, the Energy Conservation Amendment Act of 2022 introduced carbon credit trading and minimum non-fossil energy use. The October 2023 RCO notification sets renewable targets for discoms and designated consumers, rising from around 30% in financial year 25 to around 43% by financial year 30, with states also setting storage targets. The energy storage obligations require storage deployment from 1.5% to 4% by financial year 30, implying 70 gigawatt of 4-hour storage. Recent policy measures span operational guidelines for PSP and FDRE projects, a national framework for energy storage, VGF support for BESS across multiple tranches, procurement norms for storage capacity, ESS integration advisories, and extension of ISTS charge waivers. Collectively, these initiatives aim to streamline regulatory process, provide financial support, and accelerate large-scale deployment of storage solutions in India. In today's scenario, PSP and BESS are widely considered complementary technologies rather than direct competitors in the transition to renewable energy. They offer different technical capabilities that, when combined, enhance grid stability, reliability, and efficient renewable energy integration. Both PSPs and BESS have distinct advantages. PSPs are suited for long-duration storage with longer asset lifespans, while BESS offers faster deployment and greater locational flexibility. PSPs typically take 5 to 7 years to develop, whereas BESS can be deployed in 1 to 2 years, making them ideal for short-term duration. Land requirements differ too. PSPs need large, specific sites, while BESS has lower and more flexible land needs. While PSPs were historically more cost-effective, falling battery costs have narrowed the gap. A more detailed discussion on both technologies, including recent tendering activity and associated tariff discoveries, will be presented in the subsequent slides. Exhibit 10 indicates a slowdown in renewable energy tendering activity in financial year 26, primarily due to a significant backlog of over 40 gigawatt of capacity pending power sale agreement signing. State utilities have delayed the procurement of clean power, expecting tariffs to decline further and citing uncertainty over power delivery due to delays in transmission infrastructure. However, Exhibit 10 also indicates that despite the moderation in overall tendering activity, standalone storage tenders have gained traction, with around 18 gigawatt floated during 9 months financial year 26 compared to approximately 7 gigawatt in financial year 25. The recent momentum in standalone storage tenders is largely driven by the need for peak load management, reduced reliance on thermal peaking power, and the growing integration of renewable energy into the grid supported by policy measures introduced by the government. These exhibits highlight tariff discovery trends across 4 key renewable energy segments: solar, wind, wind-solar hybrid, and solar plus storage auctions. The data spans from mid-2024 to late 2025 and captures discovered tariffs in rupees per unit for each category. The analysis evaluates pricing trends, developer appetite, and relative competitiveness across segments. Solar tariffs have largely remained stable within a narrow band of 2.4 to 2.6 per unit across multiple bids. An exception was only observed in the SECI auction, where the tariff was discovered at 3.05 per unit. The elevated tariff was primarily attributable to specific tender conditions, which narrowed the competitive pool, leading to higher tariff discovery. Overall, solar continues to demonstrate tariff stability and remains the benchmark for cost competitiveness in the RE space. Wind tariffs have been consistently higher than solar tariffs. This premium reflects higher capital costs, site-specific constraints, and greater resource variability compared to solar. These structural factors continue to influence wind pricing, keeping it in a high tariff band relative to standalone solar projects. On the other hand, hybrid tariffs are positioned between solar and wind. Hybrid projects offer complementary generation profiles which help reduce intermittency risk and improve overall plant load factor. This blended generation profile supports better grid integration and enhances supply reliability. As a result, hybrid tariffs reflect a balance between cost efficiency and improved generation stability. From Exhibit 14 onwards, the storage component takes center stage. The evolving tender structures have made the storage space increasingly dynamic and competitive. We will now examine this emerging landscape in greater detail, focusing on tender sizes and corresponding tariff discoveries to better understand market direction and pricing trends. Solar plus ESS tenders. These projects are specifically designed to enable peak shifting and dispatch flexibility. Given that most of these tenders require limited duration storage, BESS emerges as the preferred technology solution. As reflected in Exhibit 14, 4-hour storage tenders command a premium of 10 to 15 paise over 2-hour storage tenders. Notably, tariff discovery in solar plus ESS tenders has been lower than in hybrid tenders and is sub rupees 3 per unit, which is driven by continued solar module cost deflation, falling battery prices, increased competition among developers, policy support through viability gap funding, and improved developer and lender confidence in execution and technology performance. It is also important to note that most solar plus ESS tenders specify short duration storage, typically for about 2 to 4 hours, and therefore developers are adding only enough capacity to meet tender requirements rather than installing large-scale storage systems. This slide summarizes the tariff trends in FDRE bids, which combine renewable sources like solar and wind with ESS to provide reliable round-the-clock power. RTC tariffs, including RTC with a short peak, range from around rupees 4.3 to rupees 4.9 per unit, higher than solar plus ESS bids due to stricter supply obligations. Solar plus ESS provides limited duration peak power with a 19 to 30% CUF, while RTC requires around 50% time block availability and 75% annual CUF, explaining the tariff premium. Among all categories, peak supply bids command the highest tariffs, typically around rupees 6.3 to 6.7 per unit, while load following bids are generally priced around rupees 5 per unit. This pattern highlights how stricter availability and reliability commitments translate into higher tariff discovery. Now, we will look at standalone ESS tenders to understand the latest tariff discoveries. The exhibit presents tariff discovery trends in standalone BESS auctions across two configurations: 2-hour 2-cycle standalone BESS and 4-hour single-cycle standalone BESS. The data spans January 2025 to November 2025 and captures both awarded energy capacity in megawatt hour and tariffs discovered in rupees lakh per megawatt per month. The trends clearly indicate a sharp drop in tariffs over a short time frame alongside increasing auction sizes. In 2-hour 2-cycle tenders, tariffs fell from rupees 2.5 lakh to rupees 1.5 lakh per megawatt per month, while 4-hour single-cycle tariffs dropped from around rupees 4.3 lakh to rupees 2 lakh per megawatt per month, reflecting a 30 to 40% decline in a short period. Market analysis indicates that the recent decline in tariffs is largely driven by a sharp drop in battery prices in 2025, which fell below $55 per kilowatt hour after May 2025. Developers anticipated these low costs to persist and assumed projects could be commissioned within the next 18 months. Combined with VGF support and low entry barriers, this intensified competition and contributed to lower tariff discovery. However, with battery prices now rising, some projects awarded at lower tariffs may face challenges, potentially leading developers to delay commissioning and slowing the pace of BESS deployment. Accordingly, CareEdge rating believes that the credit profile of such projects will depend less on the bid tariff and more on the structural factors, including sponsor strength, prudent battery degradation assumptions, clear augmentation funding mechanisms, and execution capability. Another promising long-duration storage option is PSP, which provides significant longer energy storage compared to BESS. According to CEA, India's pump storage potential is estimated at around 267 gigawatt, of which about 7 gigawatt is currently operational. In addition, projects totaling around 12 gigawatt are under construction, and a further 9.6 gigawatt has been approved but not yet started, indicating substantial planned expansion in the coming years. States such as Andhra Pradesh, Maharashtra, Madhya Pradesh, Karnataka, Odisha, and Uttar Pradesh offer favorable sites for PSP development. In financial year 2025, two PSP tenders were awarded. One MSCDCL 8-hour storage tender, wherein tariff discovered stood at around rupees 86 lakhs per megawatt per year. Another UPPCL 6-hour storage tender, wherein tariff discovered stood at about 76 lakhs per megawatt per year. Based on the tariff adoption document for MSCDCL tender, the per unit cost of storage, excluding cycle losses, works out to approximately 3.22 per unit, which aligns with CareEdge ratings cost analysis. To accelerate tender activity in PSP, the government could consider budgetary support mechanisms such as viability gap funding to make projects more financially attractive. At face value, FDRE appears more economical than thermal power, with recent tariffs around rupees 5 per unit compared to rupees 6 per unit for new thermal projects. However, this comparison must account for differences in cost structure and reliability. FDRE offers fixed tariffs over long-term PPAs, no fuel cost risk, and lower operating cost volatility due to competitive bidding. Whereas thermal tariffs are influenced by capital and fuel price fluctuations. While FDRE provides contracted firm supply within defined time blocks, peak hour support, and storage back dispatchability, typically for about 2 to 4 hours, thermal power continues to deliver 24/7 supply, multi day backup capability, and essential grid stability and inertia. Therefore, the rupees 5 versus rupees 6 comparison reflects project level tariffs rather than full system requirements, as thermal capacity may still be needed for balancing and long duration reliability, even as FDRE becomes the preferred choice for new firm capacity additions. In nutshell, FDRE is tariff competitive and financially predictable, but thermal power remains critical for system-wide reliability, with the gap expected to narrow as storage technologies evolve. This exhibit now highlights the sensitivity of the levelized cost of storage of pumped storage projects to changes in capital cost. As capex increases from about rupees 5.5 crore per megawatt to rupees 8 crore per megawatt, the LCOS rises from roughly rupees 4 per unit to just over rupees 5 per unit, indicating a strong correlation between upfront investment and storage cost. Since hydro-based projects are typically exposed to construction and cost overrun risk, capital discipline becomes critical to keep tariffs competitive. However, pump storage projects offset this to some extent through their ability to provide longer storage durations and operate over extended project lifespans, enabling better cost recovery. Best storage cost analysis indicates that 2-hour battery systems have a levelized cost of storage of rupees 2.2 to rupees 2.8 per unit, while 4-hour storage systems range from rupees 3.9 to rupees 4.9 per unit. The increase is not proportional, as a 4-hour system does not cost twice as much per unit as a 2-hour system. This is mainly because several key cost components, such as balance of plant, civil works, and auxiliary infrastructure, are shared across durations, allowing longer duration systems to benefit from economies of scale. These estimates incorporate tender-specific technical assumptions, including 85% round-trip efficiency, 85 to 95% minimum availability, 2.5% annual degradation, and the applicable VGF support. These parameters collectively shape the cost structure and materially influence the commercial feasibility of storage projects. In a nutshell, several key driving forces are poised to help the country achieve its ambitious non-fossil fuel energy target. First, growing electricity demand is being strategically addressed with a strong government focus on renewables, supported by clear RCO and ESO targets. Second, falling battery prices are making renewable energy combined with storage increasingly cost competitive, attracting strong interest from global investors. Third, lenders have shown increased confidence in funding tenders that involve energy storage components. Finally, government support through policies such as VGF for battery storage, mandatory inclusion of storage in bids, and domestic content requirements are further strengthening the growth prospects. That said, the sector is not without its challenges. Delays in signing key agreements have left over 40 gigawatts of capacity stuck in limbo, significantly slowing momentum. Additionally, the industry's heavy reliance on imports from China for solar modules and batteries exposes it to geopolitical risk that could disrupt supply chains. Execution challenges related to land acquisition, along with the slow pace of transmission infrastructure development, are creating further bottlenecks coupled with regulatory uncertainties. To conclude, the renewable energy sector in India continues to show strong fundamentals. Tariffs remain competitive, and technological advancements are making energy storage increasingly viable. Policy support, including the 500 gigawatt non-fossil target, RCO and ESO frameworks, is driving growth, while strong central off-takers reduce counterparty risk and rising corporate ESG commitments are boosting demand. Overall, investor interest remains buoyant, storage-linked bids are on the rise, and both BESS and PSP are expected to play complementary roles in India's evolving energy transition. Thank you, and over to you, Mamta.
Thank you, Soumya, for the comprehensive overview. A quick reminder to all the attendees, Please keep sending in your questions. We will take them up at the end of the discussion. Now, I would like to invite our moderator, Jatin Arya, to take the discussion forward. Jatin is a director at CareEdge Ratings and specializes in handling the energy sector portfolio. He holds bachelor's degree in business studies from Shahid Sukhdev College of Business Studies, Delhi University, and PGDM from Management Development Institute, Gurgaon. He also holds a master's degree in European business from ESCP Paris. He has industry experience of more than 12 years in the credit rating domain. Over to you, Jatin.
Yeah, thank you, Mamta, for the quick introduction and Soumya for the wonderful deck presentation. Good afternoon and a very warm welcome to one and all who have joined us for today's webinar on the renewable energy and storage landscape in India. We are actually privileged to have with us some of the most respected voices from the industry to deliberate on this important and evolving theme and to share their valuable insights. So let me introduce our esteemed panelists in alphabetical order. First panelist is Mr. Kartikeya Sharma. He's a co-founder and chief business officer at Sunsure Energy. Under his leadership, Sunsure has been able to build a robust development pipeline of around 7.5 gigawatt, and they've expanded their operations in multiple states. He's also helped Sunsure successfully expand beyond the CNI renewables into utility scale power segment. He is actually responsible for the overall operations of the company and has successfully led them and becoming one of the leading companies in this space. So welcome, Kartikeya. Our next panelist is Mr. Neeraj Gupta from Purva Green. So Neeraj has an experience of over 20 years in the industry and he has worked in various sectors such as power, renewables, and IT. He is currently leading the finance function at Purva Green, which is RPSG Group's renewable arm. He has expertise in business development, project finance, fundraising, M&A, etc. And prior to joining Purva, Neeraj was serving as CFO at Acme Group. He has also worked with reputed organizations such as Hindustan Power Projects, Tech Mahindra, Tata Motors, SAP Labs, etc. By qualification, Neeraj is an engineer and an MBA and is an alumni from IIT Delhi and IIM Indore. Welcome, Neeraj, to our webinar. Yeah, our third panelist for today's session is Mr. Pawan Agarwal from Vari Group. He is currently leading the IPP division at Vari Group and serving there in the capacity of MD and CEO. Prior to joining Vari, Pawan was the CFO at Azure Power and he has also been a banker for more than a decade. And he was heading Yes Bank's renewable energy lending division. By qualification, Pawan is a CA, ICWA, CFA, and he also holds an MBA degree from FMS Delhi. Glad to have you in our webinar today, Pawan. Yeah. And now let me introduce you to our fourth esteemed panelist, Mr. Mithil Modi, who is the business head, fintech and infrastructure finance at Tata Capital. So Mithil has been a leader in this space for more than 2 decades, and he has extensive experience in project and corporate finance. At TCL, Mithil, as the business head for infrastructure transition finance business, he manages a book of more than 24,000 crores. And under his leadership, this loan book of TCL has increased steadily at a CAGR of almost 25% over the last 6 to 7 years. By qualification, Mithil is a chartered accountant and a MBA and a law graduate as well. It's a pleasure to have you, Mithil, on our webinar.
Thank you, Jatin. Hello, everyone.
Yeah. So now for some of the preliminary remarks on today's theme before I get in the panelists. So, as Soumya also presented it out in her presentation, India's renewable energy sector has indeed undergone a remarkable, transformation over the past decade. It's emerged as one of the fastest growing clean energy markets globally. And there have been ambitious targets of 500 gigawatt non-fossil fuel capacity by 2030. And the focus now, what I believe is now it's shifting from a mere capacity addition to grid reliability and round-the-clock supply. So as renewable energy increases, variability and intermittency pose new operational challenges. This is where, energy storage, both BESS as well as PSP, they have become very important. So storage is perhaps, in my opinion, no longer a complementary asset. It is rapidly evolving into a very core enabler in the journey of energy transition, grid stability, and peak management. So there has been policy momentum, tender design, the designing of various tenders, is changing. Even the cost competitiveness of storage solutions is declining, which is accelerating a shift towards storage solutions. However, still some questions remain around the scalability, financing, the transmission readiness, and long-term market structures in this domain. So, with this context in place, I'd now like to, invite our esteemed panel to share their views on the road ahead, the key opportunities, the structural challenges, and what it will take for India to position itself as a front runner in the energy storage domain. So, I wanted to start with Pawan on the overall, market landscape. So, Pawan, over the past few years, we've seen renewable energy transition from plain vanilla solar and wind to more complex hybrid and storage-linked configurations. So, in your view, what are the key enablers that could actually accelerate the deployment of storage solutions and, enable faster integration of BESS and PSP into the grid?
Sure. Thanks, Jatin, and good evening, everyone. See, as we saw in the CareEdge presentation also, storage has become a necessity. We are talking about huge amount of electricity flowing in from renewable energy, and those are inform power. And any grid, no grid actually can take that much of capacity on such an inform basis. Now, that is the reason why a lot of focus or attention has now come on storage. And when we talk about how do we increase the investment in storage, how do we make sure that more and more storage comes into play, there are three things in my view that can actually make this sector more and more investable and increase the capacity. First is policy certainty, because we're talking about multi-billion-dollar investment, and not only in project but in manufacturing on the entire supply chain actually, right? Good part is that the storage has been considered in the national resource planning, and if you see the national electricity plan, about 300 gigawatt hour of storage has been put up as a plan that is what India will be requiring by 2930. That gives a very strong confidence for all the developers and all the investors across globe that India has such a strong storage plan as a part of their national electricity plan, and that investment opportunity will come. So that is the first thing which has been put in place. Second important is, and actually that is the first thing, is economics, right? Economics need to play. We know that storage is costly, and as Soumya presented, as we saw in the CareEdge presentation, the long duration storage, that is something that is very much needed to replace or to meet the base load. And long storage duration is coming at a cost which is significantly higher than alternate sources. So there are things like viability gap funding, stuff like ISTS waiver for PSP projects. So till these projects become fairly competitive on a standalone basis, the way it is happening for solar now, the way it is happening for wind now, when we don't need any significant amount of commercial policy support, but till our storage economics reaches to that level, some level of policy supports, and a couple of those have already been rolled out, that is going to help to reach to a reasonable scale, after which possibly it can scale up on its own merit. Third thing, which is again very important, is our grid need to be smart enough to absorb more and more inverter-based storage that is coming into play. As all of us know that India has been talking about phasing out around 20-25 gigawatt of obsolete thermal plants, which are not really very efficient from multiple perspectives. This is a public forum, so I can't talk about what are not so great advantages of running and operating those plants from the environment perspective also. But why we couldn't do that? Because our grid is not, number one, we need to have a replacement capacity before we can phase out our existing plant, because energy requirement or deficit is increasing. Second, the grid need to be smart enough or modernized enough to absorb the replacement of those baseload plants, which is currently being made by thermal, by more and more inverter-based supply. So if we take care of these 3-4 broader aspects, the way the entire ecosystem is as of now, the way the amount of focus and capital that is flowing in, I don't see there will be a challenge in scaling up the storage. Thank you.
So Pawan, in fact, you've actually pointed out quite a few things, and it all talks about more capital coming into the the industry. But on the other side, we see this persistent problem of PPA, PSA. Earlier, there used to be a problem with discom finances, payments not coming in. But post the enactment of those LPS rules, payments have started coming in. But still, the problem now comes to the other side. PPA, PSA is not getting signed in. Developers have already incurred capex. What is your view on this whole issue? I mean, by when can we see some resolution? What's the talk going on in the industry circles on this matter?
So two things actually. One, of course, this is not very motivating for all the developers that you have submitted your bank guarantees. You have one project. You have investors who have kind of committed capital, and then you don't have projects where you can spend the capital, and then you can't bid for more projects because you don't know how much capital will go into the project that you've already won. It is not a very desirable situation. But I can say this is part of cycle, and I'm very hopeful that this will get resolved, and the kind of efforts that is being taken by MNRE, MOP, the entire ecosystem, and the amount of progress also we are seeing. We are hopeful that over next 6 to 12 months there should be significant progress. And one more thing, as we know, ultimately it is economics that plays out, right? With the recent increase in BESS and module prices, right? Where we again we are seeing the chances of tariff going up, right? So what happened? So you discovered tariff at a certain rupees. The next tariff came out to be lower, and it became difficult for discom to sign a PPA at the higher tariff, knowing that the subsequent tariff is lower, right? So that economics, as we say, which becomes the prime basis for decision, whether it is by investor or lender or by discom for that matter. So even that the gap is going to narrow down with the recent increase in commodity prices and consequent tariffs. So that is one. Second, the energy consumption is increasing, right? And when we talk about discom, and when we talk about the way we plan our energy requirement for next 3 years, 5 years, 10 years, 20 years, the amount of energy that we have started consuming now, and the amount of energy we're likely to consume over next few years, and thanks to all these AI data centers and stuff like that. So with the increase in demand, with the increase in peak demand, with the increase in regular demand, discoms will have to now step up, and they need to tie up capacity. So with these two broad level of changes, and of course, a third is always that there's more and more pressure coming up for compliance of RPO. There's more pressure on going green. So those softer things, which are more like compliance and going green, and the harder things, that there is an increase in energy needs, so you'll have to tie up your PPA. You can't be waiting endlessly. And the fact that now the tariffs are again likely to increase, we believe a large part of these backlogs should get cleared.
That's a very interesting point. So now let me also get in the other panelists. So Neeraj, I had posed my next question to you. So if you look at it, energy storage still remains at a relatively nascent stage of development. So do you believe that there are structural challenges in securing financing at competitive rates, for these projects as compared to plain vanilla projects? And if so, what targeted interventions could help mitigate these risks and facilitate, more cost-effective funding for such projects?
I think that's a very pertinent question. And I'm glad to see that CareEdge presented it very correctly, that if you take the assured peak, the 4 hours storage cost, that is around 6.2 to 6.3 rupees, which is similar to what you're getting from a coal-based power plant. So, and we spoke about only 4 hours. So if you set up 6 times the renewable capacity and 6 times the battery capacity, actually you can replace a coal plant at the same price. And I also asked my team to do a quick analysis for the sake of this discussion, that if you half the battery price, if you reduce the battery price by 50%, what is the price of that stored renewable energy, which is firm power available at any given time, like a thermal power plant? The cost becomes 4.5 rupees, or 4.2 to 4.5 rupees. So, and I have seen this sector for last 12 years, when the panel prices used to be 100 cents or $1 per watt peak, and it has come down to 15 cents to 20 cents. It's a wide range, because depending upon whether you're importing from China or you're buying from India, or whether it's a DCR panel and stuff like that. But there's a 80% reduction in the panel prices. So likewise, I believe that since this storage is becoming the benchmark, or a very cornerstone whether you talk about EV vehicles or whether you talk about storage that's required for renewable assets, the prices have to fall. And the more they fall, the utilities can move towards firm power, or I would say towards a larger percentage of firm power in the overall renewable structural plants. Now, coming on to the financing, you are right. Mithil, my colleague, is there. He actually is the one who signs checks, for us. But I have seen lenders are not very comfortable with the battery structure and technology. And I can empathize with them because this is exactly what I have faced around 10 years ago, or let's say 12 years ago, when solar panels and solar renewable power was just coming up. Because the lenders didn't used to believe that the panels can last for 25 years, right? They had all these questions that, look, panels will, let's assume a 40% buffer, and the lending or the tenor of the loans could be 12 years to 15 years, because we don't know what will happen to panels after that. And I think similar questions are being asked, and these are the right questions because these are lenders. They provide us almost 3 times the equity capital that goes into a project. But my answer to that is, from the developer side, I think it's our responsibility to go very cautious, at least on the battery parameters. So what typically we do, at least, is we always take more conservative parameters than that are guaranteed by the suppliers. For example, if depth of discharge is guaranteed at a certain level, let's say they guarantee you at 97%. In our models or in our workings, we assume 95%. If they are guaranteeing 95%, we assume 93%. So, or let's say round trip efficiency, they guarantee you 85%. So we will assume 83%, 80. So we'll assume some margin of error there, because we also understand this battery is something new that is coming in. We have not seen batteries working in very high temperatures. Specifically, most of the plants are being set up in Rajasthan. And the batteries are also co-located with the solar plants, because you have to store the the afternoon hours where the solar returns peak. So we have to also see how the batteries perform at such peak hours. Good thing is the technology teams are very smart. They, in their assumptions and in their risk requirements from the vendors, we always ask that battery needs to perform at 55 degrees temperatures, rather than assuming an average temperature of 45 degrees across India and then plan for our things. So I think those, from a developer standpoint, we have to be conservative, and from a lender standpoint, they are asking for a higher level of, let's say, DSCR levels when it comes to batteries. They are asking for a higher price, which I think we are pushing them back, because the riskiness is covered by the cash flows, not the pricing part of it. But Jatin, you are right. It will take a few years before lenders turn around and they are absolutely comfortable with financing for 21, 22 odd years at a similar pricing to what standalone solar wind projects have so far. But I think initially 2 years, 1, 2, 3, 4 years, they would see, because not many projects have seen the light of day.
Correct.
Some of the hybrid projects that Renew Power has set up, right? They have also seen only 1 or 2 years of battery play on the actual conditions. But I think that so far have been very accommodative of requirements as far as batteries are concerned. And thankfully, batteries is not the 100% cost, right? In a worst case situation, batteries constitute 30-40%. So 60% is still the RE part. So that also gives lenders a lot of comfort that not 100%, the risk is mitigated across solar and battery.
Right. Thanks for sharing the developer's perspective, Mithil. I'd like to, get you in and to know, the lender's perspective on this. So, in your opinion, what kind of contractual safeguards or structuring mechanisms could, from a lender's perspective, help reduce these perceived risk and improve the access or the capital access to such projects?
Thanks, Jatin. And I think on all the points very rightly put by Pawan and Neeraj. I'll just take one step back before I, sort of answer this question. From a risk, what has happened is that the way the sector has developed, the entire renewable sector has developed over the last 10 years. The capacity addition has been fantastic, but what has also, because as we know, grid stability issue has come into question, and then now there's a duck curve that has got formed. So therefore, clearly, on a standalone solar, In fact, I would say that a standalone solar is now actually a riskier project in that sense, because obviously there are contractual safeguards, where there is development from a country perspective or from the grid perspective, because that is something that is the anyhow that we've reached milestone where we need to build capacity. Now we have to next to build stability. So that's a story forward. That is very clearly there. The question is that when we are looking at some of these storage-based projects or best projects or standalone FDREs or standalone projects also, as I asked, what is the contractual coverage? The contractual, again, I will break into two parts. So is the supply level contractual coverage. The second is the demand level contractual coverage. On the demand level, I think because the off takers, and as you also mentioned, the discom health is generally in a little better shape right now, especially that these are tendered, these are competitively bid. So there, and we've seen how the contract enforceability has also panned out over the last few years. So to that extent, I think that risk, let me put it that way. However, the supply side risk, which is how you are structuring the contract, how you are buying the projects, what are the warranty parameters, what are the guarantee parameters that are getting built in, that right now clearly not fully known. There is a known element very clearly there. Second is, even if there is a actual comfort in place, whether some of these entities who are giving this contractual coverage, they will last these 20 years or not to honor the contractual cover split itself. That itself is also to be honest something that we'll have to test it out. So given that, obviously, yes, from a risk perspective today, and this is clearly because of lack of history. Maybe 10 years back, if you would have spoken on the same lines as solar, we would have also had similar answer. So because of the lack of history, because this sector or this segment is also evolving, obviously you have to do it in a more manner. And therefore, how you are structuring the project, sizing the capacity, what portion is are there some redundancies built in the structuring of the project? Those kind of factors become very important when we are looking to assess some of these projects. And we want to, obviously, at least in the next, until we have enough track record, want to find these projects clearly, because we think this is the need of the hour. But we want to idealize them, or give the finance a little more conservative, because what also happens is a lender, our upside is not there, right? We are, it is the downside is protected, the upside is capped. So therefore, look at we protect the downside. So that is broadly been the thought process we've gone about, at least on some of these projects.
Got it. In fact, you also mentioned, and this, brings me to my next question regarding, the projects wherein there is excess of, we have access to capital and which are under construction. They've also faced some system level integration challenges. I mean, curtailments is something that we have seen, very well in the belt, in the Rajasthan Gujarat belt, and I'd like to get Karthikeya in. So, we've seen these curtailments in these regions of Rajasthan and Gujarat. While transmission additions such as, Narela Khetri ISTS line, this was expected to ease constraints. The ground reality is, at least as per our understanding, it's somewhat different. What are your views on the persistence of curtailments and the adequacy of transmission infra? And importantly, how are these challenges impacting the project cash flows and investor/lender confidence?
Thank you, Jatin. I think curtailments for renewable energy, especially for solar power in the regions that we are talking about, while they come as a surprise, because the industry is not used to such impediments. Once the project is commissioned, traditionally solar has been looked at as an asset class where the maximum risk is during the development phase. But once you're past the development phase, you generally don't bake in any risks apart from resource risk. Now, curtailments, to the best of my knowledge, have happened to projects which are operating under temporary GNA arrangements. Projects where firm GNAs have been granted, there have been no significant curtailments in the region you are talking about. On the other hand, there are intra-state projects, for example, in Maharashtra, where we have seen curtailment despite having long-term open access and firm connectivity in place for projects. So curtailments, I think, in the last year have emerged as a key concern area for solar developers, especially. And but like I said, we don't expect these to be a regular feature going forward, especially once you have the GNA. Having said that, the gap between announcement of transmission infrastructure and the actual implementation of those transmission projects remains a huge risk because it adds to the development risk that renewable energy projects anyways are running. On the ISTS network, your average project sizes are anywhere from 150 to 400 megawatts. Sometimes these are hybrid projects. With the night connectivity now coming in, a 300 megawatt connectivity would essentially allow developers to put up about gigawatt of renewable energy along with storage, right? So you're looking at 400 megawatts of solar, another 300 megawatts of wind, and maybe another gigawatt hour of BESS, right? That's the kind of configuration you can actually put on a 300 megawatt connectivity. And now, for when you're setting up a gigawatt of renewable energy assets on a transmission substation and it gets pushed by 1 year, and during that period you end up losing maybe transmission waivers, that would hurt a lot, right? So I would say that that is a more critical thing, a more structural thing that we need to solve as to how can we utilize our transmission assets better, how can we be more mindful at a policy level in allocating connectivity, and how can we also rethink our tendering paradigms so that not only are we tendering capacities which have a very firm offtake commitment on the other side, but on the other hand, these projects will also come up. Maybe you end up paying a 25 paisa premium, like we saw in the CareEdge presentation, where when the specific timeline was set, the competition narrowed. The tariffs discovered were 3 rupees 5 paisa, as opposed to maybe something like a 2 rupees 70 paisa or 2 rupees 60 paisa before that. But at least you get power within a defined time frame, and for a change, developers also make some money, and maybe Mithil and company maybe sleep easy at night looking at those DSCRs. And I truly believe that the kind of future that is in store for our country certainly has a very high power demand, and especially when we are talking about infrastructure such as data centers, the reliability of power or the availability of power is a far more important factor for these asset owners than the price of power, right? Because in the bigger scheme of things, the kind of value that we expect AI companies to create, the price of power is not something which features in their top 100 line items.
Right.
So I would say that we need to rethink how we are going to create an ecosystem where the availability of power is at a higher priority than necessarily the pricing of power. And then obviously, the necessary mix for that might include maybe a little more thermal than what we expected. But then that's the price you pay for reliability, and we should live with that.
No, perfect. This, in fact, echoes our organization's views as well. Karthikeya, I also wanted to come in on, some of the discovered tariffs that have, come in some tenders. So right now, what we've seen is that there's been a new, over the last 1 year, there's been a new stream of projects, solar plus BESS, wherein, we've seen tariff discovery somewhat 50 to 70 paisa above plain vanilla solar projects. And plain vanilla solar projects have, in fact, become more irrelevant now. There have been no subsequent or not many bids, if I could place it that way. So I just wanted to check what's your view. These projects, I mean, the former projects offer a better dispersion of electrons. Would this not represent a more attractive alternative to conventional projects from a DISCOM's perspective? And secondly, when we look at developers modeling these cash flows, they presume a significant portion of the electrons to also get sold in the merchant markets. Obviously, last 3-4 years, merchant realizations were very robust, but these are not the long-term prices that we can presume. Where do you see the merchant tariffs? I mean, it's a wild guess, I know, for anyone, maybe you, despite you being an industry insider. But what are your views on both these topics?
I think I completely agree with you that pure vanilla solar tenders, or even for that matter, pure vanilla solar PPAs within the CNI sector are a thing of the past. Uh, Both CNI and utility customers, expect more from their PPAs now. More displacement. They want at least, a 50% CUF. If they're signing up for something, they expect more coverage, in the sense that, they expect that 50% CUF to be distributed fairly well across the day. And that creates a great case for complementing solar capacities with either wind or battery storage. Wind obviously is the first preference because it gives a wider coverage. But given the dearth of wind in the country at this stage, I think a lot of off-takers are prioritizing solar plus storage because that solves another immediate problem, which is the problem of the peak time supply-demand gap, right? So if we were to look at signals coming from IEX, I think there is about a 15 to 20% ramp up in just a 2 hour window between 4 p.m. to 6 p.m. on a 500 gigawatt kind of generation capacity or a 280 megawatt kind of demand profile. You're looking at a 50 to 60 gigawatt ramp up. And thermal power plants in a growing scenario will not be able to support that in the long run, especially because most of our thermal capacities are really old, and it's more expensive to ramp them up like that. So battery storage becomes a key ally for the deployment of solar. The problem still remains that these tenders that we are talking about, while the cover says that they are a solar plus best tender, if you look at the profiles that developers are modeling, they are essentially solar heavy, right? Almost
Yeah.
80% of the energy is pure solar power, and that 20% is BESS, which comes during the peak time, and essentially they are cross subsidizing the cost of BESS by selling solar maybe at a slight premium, which by the way we are not really seeing anymore. The last 4 hour tender which closed at 2 rupees 86 paisa. If you remember, ALCM solar, pure solar was something like 260. So maybe
250,
you're
260,
getting
yeah, GUVNL tender.
250, 260, right? So you're getting maybe a 25, 30 paisa premium for the best, which as of today, the pricing which is there in the market, I don't think that works for anyone. And we are yet to see whether those kind of cuts happen in the pricing. The merchant side exposure, I think, is again a slightly gray assumption to take, especially when you're doing utility scale, right? So the utility scale PPAs clearly say that unless you fulfill the obligation under the utility PPA, you
You can't.
can't sell that power to the merchant market. So unless you're doing FDRE tender, where for a 100 megawatt PPA you are rationing a 120 megawatt connectivity, so you have that leeway to maybe play the merchant market at that time. But from our lenders and from our own analysis as well, we wouldn't want to take a significant market exposure between 11 a.m. to 3 p.m. In the long run, right? Outside of those hours, those exposures are expected to be accretive for sure. But maybe not so much in the FDRE tenders where you're anyways getting like a 5 rupees tariff.
Fair enough.
But
Yeah. Thanks for your response. So we shall also be taking questions from the audience in a short while. Meanwhile, I request the participants to key in their questions in the panel. While the questions come in, I have another couple of questions up my sleeves for Neeraj and Mithil. So Neeraj, I'd come to you. A few years ago, the REIAs had outlined plans to auction nearly 50 gigawatts annually. In FY24, we saw them, auction a similar capacity. However, there's been some slowdown in 25 and 26. So, do you see this as a clear transition from a build phase to an integration phase? And if so, could this actually moderate capacity additions and potentially impact, the 500 gigawatt team that we have for the country?
See, what I say is if you are running on a treadmill at, let's say, 12 kilometers an hour, and some of the participants, they have been running, they will probably, then after some time, you probably pause for a few, minutes or seconds, and then you start running again. So just to draw a parallel, I think in my view, the renewable agencies, they have gone over the board for calling out bids, because that's the easiest job in the whole value chain of setting up plants and supplying power to the discoms, right? Because you don't have to really ask the discoms also whether they need this kind of power or what kind of power would they need, without realizing that there could be bottlenecks at the time of supplying that power in terms of availability of transmission lines or the ISTS nodes, which the whole country is facing that issue. Without also realizing that this is an interplay of infrastructure and technology, and the prices fall of the equipment, they fall very fast. And because of that, it was not realized that the prices would fall that fast that the PSAs would not be able to sign with discoms, because discoms would be eager to see what is the next bid for the same configuration, whether I can buy that power at 10% lower or not. So I think that's a good thing that is happening for our industry. We probably there should be some pause so that the outstanding PSAs, they could see the light of the day. Because from developer standpoint, we commit a lot of energy in preparing for the bids. The BGs are required, the connectivities are required, the land visibility is required, right? And then you block those sites for a particular bid if you have win it. So if the PPAs are signed or PSAs are signed, that's a good breather for all our developers, for the developer community. But on an overall standpoint, I think this 500 gigawatts of target is still achievable, plus minus 10%. Why I'm saying so? 200 gigawatts is already operational. Some 60 odd gigawatts, as I understand, 50 to 60 gigawatts is under construction, and 40 gigawatts of the PSAs are outstanding. So if you add all that, you're talking about 300 gigawatts. And then another 200 gigawatts needs to be achieved in next, let's say, 3 or 4 years. And Jatin, also one thing we should remember, the formats of bids have changed. While my contracted capacity could be 200 megawatts, I would be setting up a 600 megawatt plant to supply 200 megawatts around the clock. So one more factor is, while the contracted capacity, we all could see only 30 gigawatts, let's say, or 25 gigawatts going forward. But at the backdrop, we would still be setting up 40, 50 gigawatt of plants between solar, wind, and, comprising battery also. So overall, I think, in my view, it's a very positive outcome that the integration is happening. The REIs are realizing that PSAs need to be signed, discoms need to be taken on board, and the transmission network should be strengthened to avoid any curtailment losses that were just spoken about. But overall, I think we are on the right path. So we should be looking at, if not 500, but 450 gigawatts of installed capacity by 2030.
Got it. So, I still had a few questions, but in the interest of time, I'll have to take a stop. I've looked at a few questions that have come in the window, and if there's one particular question that's been repeated by a lot of participants, that's perhaps for the developers, and one for the lender. Mithil can perhaps take the lender question first. So it is, somewhat a different subject. A couple of participants want to understand, that there has been advisory. Some of the IPPs are getting into module and cell manufacturing as well. Some of them already have such facilities. With the advisory coming in by MNRE regarding the overcapacity, how are you looking at such proposals? Maybe broadly, if you could just share a very brief response.
Sure. Yeah. So the advisory came, and I think back or some. But to be honest, I will break this into two. So one is, if you're setting up a standalone module manufacturing capacity versus, somebody is looking to integrate this, have a cell and then eventually look to, obviously right now it is only cell, but then, if you have a plan or a way for it to get into. Be honest, we that's been our view even far before this advisory came in, that the standalone module, there actually the way it was going, it was looking to get to capacity, and to that extent obviously we had some efforts. We were looking to sort of be slightly more risk averse on a standalone manufacturing financing, unless you are have a integrated capacity, or you are looking to integrated capacity. That is the broadly we were looking at it. So yes, this notwithstanding also, that was the thought process, and that is actually panning out. I read some statistics that we have 3 times the model was demand that is at least on an announced stage. So anyway,
Yeah.
there is an overcapacity. Yeah.
Got it. And thanks, Mithil. In fact, that's our house view as well. It broadly concurs with that. And the question to the developers, either Karthik or Neeraj, anyone could address that. So a lot many, I guess this is coming on from some of the lenders that they might have financed a lot many projects wherein the bidding assumptions were perhaps aggressive. And with the turn in cycle, battery prices also increasing, geopolitical risks taking the module prices also higher. So, how are, do you see some stress emerging? Thus far, we have not seen much, NPS coming in this sector as compared to the thermal sector. But is this is this the time when the tide turns? Broadly, if you could answer that.
Okay,
Yeah,
let me
okay, Neeraj, yeah, go ahead.
let me talk from a developer standpoint. See, the way we think about this business is our end product is power, renewable power that we sell to discoms and the central utilities. And to supply that power, if we need to do some backward integration so as to give us more confidence on the bidding assumptions, as I think Mithil rightly said, that there could be a lot of price variations when it comes to battery prices or the panel prices, right? So, because Purva, under the umbrella of RPSG Group, we have also set up a manufacturing line, and we are also going ahead and setting up a cell line as well, right? And a lot of logic is being drawn from the fact that, look, if you need to be a meaningful player in this business, then there could be some backward integration required so as to control the cost or to have a visibility on the cost. So that's one logic why a lot of developer companies like us, they are going into backward integration. The second reason, Jatin, also, I think in this business, what I have seen is it's not 0-1.
Okay.
Right? It happen that you will become the asset will become an NPA because of something went horribly wrong. Because I think you may not be able to make, let's say, mid-teen or upper teen IRRs, right? You because of wrong assumptions or because of price variability, you could go to, let's say, early teen IRRs, right? But it won't happen that you are not able to service the debt. And I'm not talking about some wind assets where some assumptions may have taken, very wrongly manner and all, right? If you build right checks and balances at the time of bidding, you have a strong technical team and a procurement team, the chances of going wrong are limited in my sense. But yes, to control the value chain from a certainty standpoint, so as to have your IRRs more certain, a backward integration, I think, is fine. It's fine in my view from a developer standpoint.
I'll just add to that,
Yeah,
Jatin.
yeah, please.
I think Neeraj covered the supply side
Supply
quite
side,
well.
right.
You're right. But I think as when you're building a long-term company in the renewable energy sector, right, as an IPP, I believe that it is very important to have good coverage on both the utility side and also the CNI side. So as a company at Sunshore, we are building a portfolio where, we are heavier on the CNI side, 65, maybe long term when we hit maybe a 10 gigawatt kind of capacity, we'll be 65, 35 CNI and utility. The CNI demand cycle in India is, I think, we are in a decadal cycle of CNI power demand growth, especially with data centers and all coming. There you have solid backers, very high credit rating kind of companies, especially with hyperscalers coming in, setting up shop in India. Um, there's an opportunity to sign large scale, highly credit worthy PPAs, even on the CNI side. So a good balance on your portfolio of both these kind of off-takers also helps IPPs hedge against such cycles, right? Because in the utility game, for example, once you made a bid, it's very hard for you to adjust for these kind of changes. Whereas on the CNI side, because it's more of a bilateral arrangement, and like I said over there, it's more of a question of availability of power and reliability of power than maybe 10 or 20 paisa here and there. That really gives us, it has given us, at a portfolio level, a lot of confidence in going out and continuing our growth trajectory despite these commodity shocks.
Understood. Perfect.
Yeah. Just to also add, Jatin, because we always look at the portfolio level. And you
Correct.
have this industry has been cyclical. Sometimes the prices go up, but generally the prices have been falling. So I've also seen that maybe in some cases your IRRs will drop, but then you will quickly catch up in the next cycle. So
Yeah,
Right.
absolutely.
on a longer term, I think Karthik and you would agree it averages out.
Yeah, it pans out.
Absolutely. It has
Yeah.
to be a long-term play, right? I think
Yes.
the biggest downside for these kind of cyclical shocks is borne by platforms, which kind of get floated with a 4 to 5 year
Yeah.
timeline in mind,
Horizon,
right?
yeah.
If you're building a long-term company and you have that mindset, you're building those internal capabilities, get the opportunity to be open to opportunities like Neeraj said, like backward integration. And in that kind of an approach to business, you are able to weather these shocks.
Perfect. Perhaps I mean, we had a lot more questions, but in the interest of time, we'll have to conclude. Heartfelt thank you to all our esteemed panelists for sharing their insights and for patiently addressing the audience's queries. It's been a privilege to host Karthikeya, Neeraj, Pawan, and Mithil, and we sincerely appreciate your perspectives on the subject. Thank you to all the participants for taking out time to join and engage in this Care Ratings webinar. I'll now hand over to my colleague Mamta for the closing remarks.
Thank you, Jatin, for steering such an insightful discussion. A heartfelt thanks to all our distinguished speakers for sharing their valuable perspectives on the current dynamics of the renewable energy sector. It was truly an honor to have you with us. To our participants, thank you for joining us and engaging with us. We look forward to your feedback. For any further queries, suggestions, or comments, please feel free to respond to the feedback email we'll receive shortly. That brings us to the end of today's CareEdge webinar. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you,
Thank
everyone.
you.